Imagine standing at the edge of a vast ocean teeming with countless opportunities. This, my friends, is the stock market. An intricate web of transactions, a bustling marketplace where fortunes are made and lost. But to the uninitiated, it may seem like a chaotic whirlpool of numbers and charts. Fear not, for beneath this seemingly chaotic surface lies a world of opportunity waiting to be discovered. The stock market is a reflection of our global economy, a mirror that reflects the financial health of companies, industries, and economies. It's influenced by a multitude of factors, from political events and technological advancements to environmental concerns and social trends. This is why understanding market trends and economic indicators is crucial. They are the compass that guides us through this vast ocean, showing us where the currents are moving, signaling the rise and fall of economic tides. Just as a sailor studies the weather patterns and ocean currents, a smart investor studies market trends and economic indicators. They help us understand the bigger picture, the macroeconomic landscape in which companies operate. They are the signposts that guide us towards potential investment opportunities and away from potential pitfalls. Understanding these trends and indicators is not just about reading charts and reports. It's about understanding the story behind the numbers, the narrative that unfolds within the economic landscape. It's about understanding how a change in interest rates can impact a company's profitability, or how a shift in consumer behavior can disrupt an entire industry. So, how does one navigate this ocean of opportunities? The answer lies in knowledge, practice, and strategy. By equipping ourselves with the right tools and the right mindset, we can turn the stock market's complexity into a source of opportunity. We can learn to read the market signals, to understand its language, to navigate its currents. The stock market is not a gamble, it's a game of strategy. And knowing how to play this game is what separates the successful investors from the rest. It's about understanding the rules, studying the players, and making informed decisions. It's about taking calculated risks, learning from your mistakes, and constantly adapting your strategy. So, are you ready to embark on this journey of discovery? To explore this ocean of opportunities? To dive into the world of investing and uncover the secrets of the stock market? The journey may be challenging, but the rewards can be substantial. So, let's set sail and navigate this ocean together. Just as a ship captain navigates through treacherous waters, so must an investor navigate through the sea of companies. The process of company analysis is akin to charting a course, a crucial step in our investment adventure. Company analysis provides a window into a company's financial health and operational effectiveness. Think of it as a snapshot of a company's life, where every figure and statistic tells a story. To begin, we dive into financial statements, the lifeblood of any company. These include the balance sheet, income statement, and cash flow statement. Each of these documents offers a different perspective on a company's financial health. The balance sheet, for instance, is like a photo, capturing a company's assets, liabilities, and shareholders' equity at a specific point in time. On the other hand, the income statement is more like a film, capturing the company's revenues and expenses over a period. It tells us whether the company is profitable or not. Lastly, the cash flow statement shows us how the company manages its cash, providing insights into its liquidity and long-term solvency. Then we explore the company's business model. It's crucial to understand how a company makes its money, its competitive advantage, and its growth prospects. A robust business model suggests the company can withstand economic downturns and remain profitable in the long run. When analyzing a company, it's also important to consider external factors like industry trends and economic indicators. For instance, a company might be performing well, but if it's in a declining industry, its future might not be as bright. Lastly, remember that numbers are just part of the story. It's also important to consider qualitative factors like the company's management team, corporate governance, and social responsibility. Remember, an informed investor is a successful investor, so always do your homework before investing. By understanding the art of company analysis, you can better navigate the sea of companies and find those that are truly worth your investment. A compass guides a sailor in the right direction. Similarly, valuation techniques guide an investor towards profitable stocks. Now, let's sail into the fascinating waters of stock valuation. Valuation techniques are like the North Star for investors, helping them navigate the vast ocean of the stock market. These techniques provide a framework to understand the true value of a company and its stocks beyond the market price. And why is this important? Because every investor's goal is to buy stocks that are currently undervalued but have the potential to grow in the future. One of the most common valuation techniques is the price-to-earnings ratio, or PE ratio. This ratio compares a company's current share price to its per-share earnings. A lower PE ratio could indicate that the stock is undervalued, making it a potentially attractive investment. However, it's crucial to remember that a low PE ratio isn't always a good sign. It could also mean that investors are expecting lower earnings growth in the future. Another vital technique is calculating the intrinsic value of a stock. This is the perceived value of a stock based on future earnings and growth rather than its current market price. It's like looking at a seed and trying to estimate the size of the tree it could grow into. The intrinsic value helps investors determine whether a stock is overvalued or undervalued. If the intrinsic value is higher than the market price, the stock might be a good buy. But remember, valuation is more of an art than a science. It involves making educated guesses about the future based on current information. And while these techniques can provide direction, they can't predict the future with absolute certainty. Valuation isn't about predicting the future, but rather about understanding the present value of future potential. So, grab your compass and let's continue our journey into the world of investing. Just as a lifeboat is essential for survival at sea, risk management is crucial for survival in the stock market. Now let's delve into the world of risk management, the lifeboat of investing. Imagine you're on a voyage, crossing the vast ocean of the stock market. You wouldn't set sail without a lifeboat, would you? In the same vein, venturing into the stock market without a solid risk management strategy is like sailing without a lifeboat. It's not just risky, it's downright dangerous. Risk management in investing is all about safeguarding your investments against potential losses. It's your safety net, your buffer against the uncertainties of the market. And how do we do this? Through diversification and the concept of the margin of safety. Let's start with diversification. The term might sound a bit jargony, but it's pretty straightforward. Diversification is simply spreading your investments across a variety of assets, sectors, or companies. Think of it as not putting all your eggs in one basket. If one of your investments goes south, you won't lose everything because your other investments can offset the loss. That's diversification for you. Now, let's talk about the margin of safety. The margin of safety is the difference between the intrinsic value of a stock and its market price. It's like a buffer that protects you from overpaying for a stock and potentially losing money. The larger the margin of safety, the lower the risk. Remember, the goal is to buy stocks for less than they're worth, not more. Both diversification and the margin of safety are powerful tools that can help you navigate the unpredictable waves of the stock market. They can protect you from substantial losses and keep your investment portfolio afloat even during turbulent times. Investing isn't just about making profits, it's also about minimizing losses. That's where risk management comes into play. So grab your lifeboat of risk management and set sail on your investment journey with confidence. History is a great teacher, and for investors, the history of the stock market is full of valuable lessons. Investing, at its core, is a psychological game. Behind every trade, every decision to buy or sell, there's a human with their own thoughts, emotions, and biases. This human element, this investor psychology, can often be the deciding factor between success and failure in the stock market. So what can we learn from the past? Well, quite a lot. Take the dot-com bubble of the late 90s, for example. A time of irrational exuberance, where internet-based companies with little to no profits were valued at sky-high prices. The bubble burst, and many investors learned a hard lesson about the dangers of speculation and the importance of fundamentals. Or consider the subprime mortgage crisis of 2008. Greed and overconfidence led to risky lending practices, which eventually resulted in a global financial meltdown. The lesson here? Risk management is crucial, and it's important to understand what you're investing in. But it's not just about learning from mistakes. Success stories also offer valuable insights. Think of Warren Buffett, one of the most successful investors of all time. His strategy? Long-term value investing. He buys stocks of companies that he believes are undervalued and holds onto them for years or even decades. This approach requires patience and discipline, but it has proven to be extremely successful. Understanding investor psychology can help you avoid common pitfalls and make more informed decisions. It can help you stay calm during market downturns and avoid getting caught up in the frenzy during market booms. It can also help you develop a long-term investment strategy that aligns with your risk tolerance and financial goals. Remember, investing isn't just about numbers and charts, it's also about understanding human behavior. Because at the end of the day, the stock market isn't just a collection of numbers, it's a reflection of collective human decision-making. The stock market is a reflection of human emotions. Understanding this can give you an edge in your investing journey. Now that we've navigated through the vast ocean of the stock market, it's time for you to set sail on your own investment journey. We'd love to hear about the stocks you're eyeing. Perhaps you've discovered a hidden gem. And if you're looking to build a robust portfolio, remember, we're here to guide you. So don't forget to hit that subscribe button. Thank you for joining us on this journey to investment mastery. Remember, patience, research, and a bit of courage are the keys to unlocking the stock market's hidden gems. Keep learning, keep investing, and until next time, stay savvy.